Yesterday, the RBI did something that has never happened in the banking industry. It cancelled the banking license of Paytm Payments Bank. Now, before you panic, if you have money in a Paytm wallet, your money is safe. I'll explain exactly in this video. But this story isn't just about Paytm. It's about what happens when a fintech company gets so big, so fast, and that it forgets about the regulator watching from the corner. 4 years of warnings, 4 years of restrictions, and finally, on April 24th, 2026, the RBI said enough. In this video, I'll break down exactly what went wrong, what the license cancellation actually means, and most importantly, what every aspiring fintech professional needs to learn from this. Let's get into it. Okay, first things first. What even is a payments bank? Think of it like this. Imagine your neighborhood dhabawala. He can safely hold your wallet for you. He can send money to your family in the village, but he cannot give you a loan. He doesn't do credit. That's a payments bank. Technically speaking, a payments bank is a type of a bank that the RBI created in 2015 to increase financial inclusion in India. It can accept deposits from you up to 2 lakh rupees per customer, issue debit cards and internet banking, offer remittance services, sending money from city to village, and sell mutual funds and insurance, but only as an agent. But here's the big restriction: a payment bank cannot give loans, it cannot give you credit. It's a deposit and transfer machine, not a full bank. In 2015, RBI issued 11 of these licenses. Paytm was one of them. Today, only 6 are still operational. The Paytm Payments Bank is about to become the seventh to shut down, but it'll be the one to be forcibly cancelled. Now, let's walk you through what actually happened, because this didn't happen overnight. August 2015, Paytm Payments Bank gets its RBI in principle license. Vijay Shekhar Sharma holds 51%, 197 Communications, the parent company, holds 49%. Ant Group and SoftBank are investors. The future looks golden. Now, in March 2022, the first major red flag: RBI bars Paytm Payments Bank from onboarding any new customers. No new accounts, think about that. A bank that can't add new customers. The compliance issues were serious enough that RBI stepped in, but Paytm continued operating with existing customers. Next, in January 2024, RBI escalates. It orders the bank to stop accepting fresh deposits at all. No new money coming in. This is when the public panic started, and rightly so. In February 2024, Vijay Shekhar Sharma stepped down as the non-executive chairman of Paytm Payments Bank. 197 withdraws its nominee from the board. Veteran banker S. Sridhar is brought in, but the damage is done. And finally, in April 24, 2026, RBI formally cancels the banking license under Section 22(4) of the Banking Regulations Act 1949. Effective close of business, April 24th, 2026. The RBI also announces it will approach the High Court to wind up the bank. So, what exactly did Payments Bank do wrong? RBI cited four main reasons. Number one, KYC failure. KYC stands for Know Your Customer. Every bank in India is required to verify who you are before opening an account with your PAN, your Aadhaar, your address. Paytm Payments Bank reportedly opened accounts without completing this process properly. Multiple accounts were linked to the same PAN number, which is a massive anti money laundering red flag. Basically, if a criminal can open 10 accounts in your name, that's a serious problem. And RBI found exactly this kind of mess. Number two, suspicious fund flows. The money moving through accounts didn't match the declared profile of the customers. Amounts too large, patterns too unusual. RBI inspectors flagged these during their on site audits. Number three, tech system non compliance. RBI has a very specific requirement around data localization. When you store Indian customer data and around regulatory reporting, Paytm Payments Bank reportedly wasn't fully meeting these. And number four, governance failures. And this is one that stings the most. RBI explicitly said in writing that the conduct of Vijay Shekhar Sharma and the overall governance of the bank was, quote, detrimental to the interest of depositors. When a regulator says that about a founder, that is not a warning, that's a verdict. Now, a lot of people are asking, how does RBI actually cancels a bank license? Is it sudden? Can they just do it? No. The RBI process is actually very patient and very deliberate. There are five escalating steps. Step 1, inspection and audit. RBI does regular on site inspections. This is where issues like KYC gaps or suspicious transactions get spotted internally. Step 2, show cause notice. RBI sends a formal notice asking the bank to explain itself. The bank gets a chance to respond and fix things. Step 3, business restrictions. If RBI is not satisfied, it starts restricting what the bank can do. For Paytm, no new customers in 2022 and no fresh deposits in 2024. Step 4, license cancellation. The final regulatory blow. Under Section 22(4) of the Banking Regulations Act, the bank loses the right to conduct banking business entirely. Step 5, High Court winding up. RBI approaches the High Court to formally dissolve the bank and ensure depositors get their money back. Paytm went through all five steps. That's not bad luck. That's a pattern of non-compliance that the regulator simply couldn't ignore any longer. Okay, now the question everyone is asking, what happens to my money? The short answer is your money is safe. Here's what RBI has confirmed. Paytm Payments Bank has 1395 crore rupees in customer deposits across wallets, savings accounts and current accounts. The RBI has explicitly said that the bank has sufficient liquidity to repay every single depositor. Withdrawals are permitted without any restrictions. You can take out your full balance right now. What stopped and what won't come back is new deposits. No new money can go in, no new accounts can be opened, and once High Court approves the winding up, the bank will formally cease to exist. So, as a depositor, get your money out and let the process run. Either way, RBI has your back. And now here's the part that surprised a lot of people. Within hours of RBI announcement, 197 Communication, the parent company, put out a stock exchange filing that said Paytm and its services will continue to operate uninterrupted. There is no direct financial impact on the company. And they are not lying. Because here's the thing, Paytm, the app, and Paytm Payments Bank are two separate legal entities. When RBI put the first restrictions on the bank in early 2024, Paytm was smart enough to pivot. It moved to what's called the TPAP model, third party application provider. Basically, the Paytm is now just an app. It doesn't own the bank rails anymore. Its UPI services now run through Yes Bank. It got a payments aggregator license from RBI and it had already written off its entire investment in the bank as of March 24. So the brand survives, the bank doesn't. And Paytm's core services, which are the app, UPI, QR code, Soundbox, and payment gateway, all of it is fully operational today. So, what does all of this actually mean for Indian fintech beyond the Paytm story? Lesson number one, compliance is non negotiable. I don't care how big your brand is, I don't care how many crores you've raised. If you are operating a licensed entity and you cut your corners on KYC, on AML, on data reporting, the regulator will catch you and they will shut you down. There are no exceptions. Lesson number two, regulatory forbearance has limits. RBI gave Paytm Payments Bank 4 years of warnings, restrictions, board level changes. Regulators are very patient, but they are not infinite. If you keep ignoring the signals, you will hit the wall. Lesson number 3. Your brand is not your license. Paytm is a brand worth thousands of crores. Paytm Payments Bank was a regulated entity that just got cancelled. These are two different things. Always understand the legal structure behind the brand name. And lesson number 4. The payments bank model itself may need a rethink. Of 11 licenses issued in 2015, only 6 are operational today. Several surrendered even before launching. That is not a success story. The model was designed for financial inclusion, but the restrictions might be too tight for it to be commercially viable in the long term. Okay, let's wrap this up. 5 things to remember from this video. 1. A payments bank can hold your money and transfer it, but it cannot lend. Think dhabawala with your wallet, not a full banker. 2. RBI cancelled Paytm Payments Bank license under Section 22(4) of the Banking Regulations Act on April 24, 2026, the first cancellation of this kind in recent Indian banking history. 3. The root causes were KYC failure, suspicious fund flows, tech non-compliance, and governance failures, accumulated over 4 years of warnings. 4. Your depositor money, all 1,395 crores of it, is safe. RBI has confirmed full liquidity. Withdrawals are allowed. 5. Paytm the app survives by pivoting to the TPAP model. It runs on Yes Bank's rails now. The brand lives, the bank doesn't. If you are building in fintech or hoping to work in it, this case study is one you need to know, not because Paytm failed, but because of how the regulator responded and what that tells you about how India governs its financial systems. If this video helped you understand something you didn't before, leave a comment with the one thing you are taking away. It really helps me know what to make next. And if you haven't subscribed yet, Fintech Teacher drops a new video every week. Indian Fintech explained simply. See you next week.